Do you think that everyone who consistently makes money in the market has a high IQ? Are they super intelligent individuals who develop the most secret strategies that no one else sees? Or are they disciplined traders who have mastered managing their emotions and psychology by adhering to their systems and rules? Let me paint a picture you'll probably recognize. Tuesday morning, you've done your analysis. You've set your levels. A perfect setup is forming, everything aligning exactly as described in your trading plan. But you hesitate. Your finger hovers over the button and you freeze. Why? Because yesterday you suffered a loss, a foolish loss. You broke your own rules and paid the price. Now that moment weighs on your chest like a burden. And even though today's setup is completely different, completely valid, you can't pull the trigger. So you watch. The trade unfolds exactly as you predicted. It hits your target, but you're not in it. Now something dangerous is happening inside you. The disappointment grows. You feel angry at yourself. A voice whispers, "You knew. You should have done it." And most traders fall into a trap here that will haunt them for years. The next candle forms. Another opportunity arises, but this one is different. It's unclear. It barely meets your criteria. A week ago, you would have missed this opportunity without a second thought. But today, you can't think clearly. Today, you're trying to make up for the opportunity you missed. Today, you're not trading the market. You're trading your emotions. You enter, and you lose. Again. This is not bad luck. It is not the market's unfairness. It is a psychological pattern repeated thousands of times every day among millions of traders. And until you understand why, you are trapped in a cycle you cannot escape. It's not the market that's ruining your account. It's you. And until you accept that, you'll keep losing money by blaming everything else. Your strategy, algorithms, news, manipulation. But the harsh truth most traders don't want to hear is this. You are your own worst enemy. And the battlefield isn't on the charts. It's inside your head. The moment you learn to face yourself, to truly see the patterns that ruin your trades, everything changes. But I must warn you, what you will learn will force you to face the parts of yourself you've been avoiding. Most investors would rather lose money than face reality at this point. If you're still here, you may have what it takes. Here's what's really going on in your brain at these moments. When you miss a trade, even if you haven't lost money, your mind records it as a loss. The human brain struggles to distinguish between actual losses and missed opportunities. Both trigger the same pain centers. Our ancestors survived by being more sensitive to threats than rewards. Losing resources could mean death. Missing a meal was dangerous. Therefore, your brain struggles to distinguish between losses and missed opportunities. This situation seems to be encoded in the psyche of generations as a survival mechanism formed over generations. Now let's translate this into trading. You miss out on a profitable trade, and your mind screams, "We lost something. Fix it. Do something." And in this emotional alarm state, you make the worst possible decision. You jump into a trade you shouldn't be doing, trying to recoup something you never actually lost. Sound familiar? FOMO, or the fear of missing out. It's not just an internet buzzword, nor is it just a term related to trading. It can arise in any situation in life. Let's address the fear of missing out through trading, a psychological phenomenon that destroys more trading accounts than bad strategies ever could. FOMO emerges when you see the price moving without you, when you're sitting on the sidelines, watching the candle move in the direction you wanted, when you're scrolling through social media and see other traders sharing their profits. Your brain interprets all of this as falling behind, missing out, everyone getting rich while you do nothing. And here's the cruel irony. The more disciplined you try to be, the more FOMO hurts you. Because discipline means waiting. It means rejecting opportunities that don't meet your criteria. It means watching opportunities slip away. And every time you do this, the fear of missing out whispers to you, what if this one is the right one? What if you're being too cautious? What if everyone else is making money right now? Let me tell you how FOMO looks in real trading. You wake up, you check your charts. The market has moved 200 points in the direction you expected, but you didn't enter the trade because the move happened overnight, or you were waiting for a pullback that never came. Now, you're looking at a chart that's already stretched out. The rational part of your brain knows this isn't the right time to enter. The move has already happened. The easy money is gone. But FOMO doesn't care about rationality. FOMO shows you the green candle and shouts, "It's still going. Get in now before you miss out on more." So you follow it. At the worst possible time, at the peak of the movement, you enter just before the pullback you should have waited for. And when the price reverses and stops you out, you're left with regret. This is the FOMO cycle. And whether you realize it or not, it happens again and again in your trading. You miss a move, you suffer. You chase the next move. You lose money, you suffer more. You become more desperate. You make worse decisions. This cycle continues until your account is empty or your spirit is broken. However, the fear of missing out is just the beginning, because beneath the surface lies something even more destructive, something most investors don't realize until it's too late. Revenge trading. Let me explain revenge trading so clearly that you can't ignore it in yourself. Revenge trading emerges when you stop trading the market and start trading against yourself. It emerges when your goal shifts from making good decisions to proving something, proving you're not stupid, proving you can win, proving your last loss was just bad luck. It usually unfolds like this. You experience a loss. Maybe it was a good trade, but it didn't pan out. Maybe it was a mistake. Either way, you lost money, and something inside you refuses to accept it. Not the money, but the meaning behind it. Maybe that you were wrong. Maybe that you didn't understand it. Maybe that you're not as good as you thought. So instead of stepping back, taking a breath, and resetting, you immediately start looking for the next trade. But you're not looking with a clear eye. You're hunting. You're scanning the charts with one purpose, to find anything that will get your money back. In this state, opportunities that normally wouldn't interest you suddenly become appealing. You start rationalizing. You start bending your rules. It's close enough to the support level. There's some kind of pattern here. The trend hasn't broken yet, so it should work. These aren't analyses. These are justifications your emotional brain creates to get what it wants. And what it wants isn't profit. It wants to not feel like a loser. It wants to erase the pain of the last trade immediately, so you get back in. And because you're entering for emotional reasons, rather than strategic ones, the odds are against you. You lose again. Now the pain is doubled. Now the desperation intensifies. You've lost twice now, and your brain is in full survival mode. At this point, investors blow up their accounts, not with a single trade, but in a spiral of revenge trades that compound their losses. I've seen investors lose more in 3 hours of revenge trading than they earned in 3 months of disciplined work. I was that investor. The worst part about revenge trading is that it feels productive. You feel like you're doing something, like you're fighting back, like you're not giving up. But you're not fighting the market. You're fighting yourself, and you always lose that fight. Now let's talk about overtrading, because revenge trades and FOMO combine here to become something even more insidious. Overtrading isn't just about making too many trades. It's a sign of a deeper psychological need that has nothing to do with making money. Ask yourself honestly, why are you trading? Don't ask why you started trading. Ask why you sit down at your computer every day. If the answer is purely financial, you should be happy on days when there are no good opportunities. You should feel relieved when you can walk away without taking any risks. But most investors don't feel that way. Most investors feel anxious, restless, and almost itchy when they're not trading. Why? Because for many investors, trading has become something other than just about money. It has become exciting. Something exciting. Feeling alive. Proving something to yourself or others. Escaping boredom or avoiding problems in other areas of life. When trading fulfills these psychological needs, not trading becomes impossible. Every day without taking a position feels wrong. Every hour without checking the charts feels wasted. And so you trade. Not because there are setups, but because you need to trade. You need the action. You need the dopamine rush that comes from taking a position. You need to feel like you're doing something. This is excessive trading and financially harming yourself under the guise of hard work. Here's something no one tells you. The best traders trade less than you think, much less. They can watch the markets for hours and make only one trade. Or they may not trade at all. They understand something that excessive traders never grasp. Every trade is a risk, not just a risk to your capital, but also to your psychology, your discipline, and your edge. Every time you enter the market, you expose yourself to potential losses, potential emotional damage, potential bad habits. The less you expose yourself to risk, the less likely you are to fall into destructive patterns. However, this requires something most investors lack. It requires not being uncomfortable with inaction. It requires finding peace in patience. And that brings us to the fundamental problem. The reason FOMO controls you. The reason revenge trading makes you addicted. The reason excessive trading becomes compulsive. It all boils down to one thing. You don't truly know yourself. You don't know your triggers. You don't know your patterns. You don't know what emotional state you were in when you made your worst decisions. You're trading blindly, not blindly to the market, but blindly to your own psychology. And that's why you need to confront yourself, not with vague self-reflection, not with motivational affirmations, with systematic, uncomfortable, brutally honest self-accountability. This is where the real work begins. Most investors fail here because facing yourself is harder than analyzing any chart. But if you're willing to do what others won't, you can achieve what others can't. In the next section, I'll show you a 5-step system that will transform your relationship with trading. A system built on a simple yet powerful tool that most investors completely overlook. Your trading journal. But not the kind of journal you're thinking of. Not a record of entries and exits. Something much more powerful. Something that will show you exactly who you are as a trader and, more importantly, who you need to be. Most investors keep some kind of trading journal. They record their entries, exits, profits, and losses, maybe even a screenshot of the chart. Then they never look at it again. Or they look but see nothing useful, just numbers. Data points that don't explain why they keep making the same mistakes. This is not journaling. This is record keeping. And record keeping won't save you. What I'm going to show you is different. This is a system designed not to track your trades, but to reveal your psychology, to make the invisible visible, to catch the patterns that destroy your account before they completely wipe it out. This is a 5-step system to confront yourself and master your trading psychology. And it starts with something you've probably never done properly. Step 1. Create your emotional trading journal. Forget everything you know about trading journals. We're not tracking technical data here. We're tracking you, your emotions, your thoughts, your physical state, your decisions, and most importantly, the connection between them. Here's what you need to record for each trade. Not after the trading day, not whenever you feel like it. For each trade, in real time. First, the timestamp. Not just the date, but the exact time. This is more important than you might think, and I'll explain why later. Second, your emotional state before the trade. Most traders fail at this point because they don't know how to accurately identify their emotions. Let me give you a framework. Ask yourself these questions before every trade. Am I calm or excited? Am I patient or impatient? Am I thinking clearly or is my mind cluttered? Am I trading because I saw an opportunity or because I felt I had to trade? Write down the answers. Use specific words. Don't just write, I felt good. That means nothing to you. Instead, write, I was anxious because I missed the previous move. Or, I was confident because my last 3 trades were profitable. Or, I was bored because the market was stagnant all morning. Third, your physical state. It may sound strange, but your body holds information that your conscious mind misses. Are you tired? Hungry? Stressed about something unrelated to trading? Did you sleep well? Are you sitting up straight or slouching at your desk? Is your jaw clenched? Are you breathing normally or holding your breath? By tracking my physical state, I discovered something about myself that shocked me. I realized that I did almost all of my revenge trades when I was slightly hungry. My blood sugar would drop, my patience would disappear, and I would make impulsive decisions. After noticing this pattern, I created a rule. Don't trade within an hour of feeling hungry. Simple. But if I hadn't followed it, I would never have discovered it. Fourth, trade details. Record the technical information. Entry, exit, stop loss, take profit, setup type, rationale. But add one more element, confidence level. On a scale of 1 to 10, how confident were you when you entered this trade? Write this down before you know the outcome. Fifth, and this is the most important part, the outcome of the trade and your emotional response. Did you win or lose? By how much? But more importantly, how did you feel when you closed the trade? What kind of thoughts crossed your mind? What was your first reaction after the trade closed? If you won, were you satisfied, or did you want more? If you lost, did you accept it, or did you get angry and want revenge? Did you immediately start looking for the next trade? Or did you take a step back and reset? This is where the gold lies. This is where you will begin to see who you really are. Now, I know what you're thinking. This sounds like a lot of work. It is. That's why most traders don't do it. That's why most traders lose money. The traders who are willing to do the uncomfortable work survive. The others just gamble with extra steps. Step 2. Uncover your emotional patterns. After 2 weeks of detailed journaling, you'll have enough data to start the real analysis. This is where you stop being a trader and start being a detective. A detective investigating yourself. Open your journal and look for correlations, not between your strategy and your results, between your emotional states and your results. Start with the trades you lost. Examine each one and look at what you wrote in the emotional state section. Do you see any patterns? Are there recurring words? Are there recurring situations? When I did this exercise, I found this. 70% of my losing trades happened when I recorded feeling impatient or disappointed before entering. 70%. This means most of my losses stemmed solely from my impatience, not my strategy, not the market, not being able to wait. Another pattern I discovered, when I recorded feeling confident at level 8 or higher, I was winning more often. However, when I recorded feeling very confident at levels 9 or 10, I was losing more often. Overconfidence was literally costing me money. I was taking bigger risks, ignoring warning signs, assuming I couldn't be wrong. Now look at the trades you've won. What emotional states were present before them? What physical states? What times of day? You may notice that your best trades occur during the first 2 hours of the session, when your mind is fresh, or that you trade better after exercising, or that you always make money on Tuesdays but lose on Fridays. These patterns were there before, but you weren't aware of them because you hadn't been paying close enough attention to notice them. Here's a framework for pattern recognition. Create categories and count the frequencies. Category 1. Emotional state before trading. List every emotion you recorded and count how many times each appeared in winning trades and losing trades. Category 2. Time of day. Divide your trading day into segments and calculate your win rate for each segment. Category 3. Physical state. Relate physical conditions to outcomes. Fatigue and alertness. Fullness and hunger. Exercise and inactivity. Category 4. Behavior following a loss. What do you typically do after a losing trade? Examine the trade made after each loss. What is the win rate of these trades compared to your overall win rate? Let me tell you what most traders find here. The win rate of trades made immediately after a loss is significantly lower than normal. Why? Because of everything we mentioned earlier. Revenge trades, emotional reactions, the desperation to recoup the loss. When you analyze your data, did you see that my win rate dropped by nearly 40% in trades made within 30 minutes of a loss? 40%. These trades are essentially like flipping a coin, or even worse. When you see and analyze the data, the solution becomes clear. For example, don't trade for at least 15 minutes after any loss. You've now created a simple rule based on your interpretation of the data. You can now test the effectiveness of this rule on your emotions and trades. Step 3. Identify your triggers. Now that you can see your patterns, it's time to dig deeper. Patterns tell you what happened. Triggers tell you why. A trigger is a specific stimulus that initiates an emotional response. It's what happens right before you feel FOMO, anger, fear, or greed. Until you identify your triggers, you're just reacting to emotions without understanding where they come from. Let me give you examples of common trading triggers. Trigger 1. Watching the price move without you. You had your analysis, you saw the setup, but you didn't enter, and now the price is rising. This triggers FOMO, which leads to chasing, which leads to buying at the top and selling at the bottom. Trigger 2. Seeing other traders' profits. While scrolling through social media, you see someone share a big win. Suddenly, your own results start to feel inadequate. This triggers comparison anxiety, which leads to overtrading, where you start compromising to make setups acceptable that aren't suitable for your system. Trigger 3. Approaching a round number. Your profit and loss is at a $980 profit. You only need one more trade to reach $1,000. This triggers arbitrary target fixation, leading to unnecessary trades to reach a meaningless number. Trigger 4. Being stopped out just before the price reverses. You had the right idea, but your stop level was too tight. The price tagged your stop level and immediately reached your target. This leads to disappointment and self-doubt, which causes you to widen your stop levels beyond your rules or hesitate on the next valid setup. Fifth trigger, breaking even on a winning trade. You made a significant profit, didn't take your profit, and watched your winning trade break even or turn into a loss. This leads to a mix of regret and greed, causing you to take your profit too early in future trades and leave money on the table. How to identify your personal triggers is explained below. Go back to your journal and look at your worst trades. Examine not only the trades where you lost the most money, but also the trades where you clearly violated your rules, the trades you know better. For each of these trades, ask yourself, what happened in the 30 minutes before I made this trade? What did I see, hear, or think that could have influenced my decision? Write these down. Be specific. I saw a tweet about someone who made $10,000 on an opportunity I missed. Or, I made $500 and wanted to reach $1,000 before lunch. Or, I had just exited a trade that could have been successful if I had held it longer. These are your triggers. Once you identify them, you can develop defense mechanisms against them. The goal is not to eliminate emotions. You can't do that. You are human. The goal is to create a gap between the trigger and your reaction, allowing it to act as a buffer. It is to recognize that you have been triggered before acting. Here's a technique that works. When you realize you want to make a trade, stop and ask yourself this question. Am I making this trade because it's a valid setup or because something triggered me? If you can honestly answer that, it's a valid situation, go ahead. If you have any doubts, if you felt any emotional fluctuations in the last few minutes, don't trade. Step away from the screen. Get a drink of water. Take a breath. Come back in 10 minutes and reassess the situation. This pause is everything. It's the difference between reacting and responding. It's the difference between your psychology controlling you and you controlling it. Most investors skip this pause. They feel the trigger, they feel the emotion, and they act immediately. This is not trading. This can lead you into a gambler's mindset. How to turn your insights into unbreakable rules and create daily practices that make confronting yourself automatic. Because knowing your triggers isn't enough. You need systems that will protect you from yourself even when your willpower fails. And believe me, your willpower will fail. It always does. That's why we don't rely on willpower. We rely on structure. These structures are personalized. Gain awareness by keeping a trading journal. Discover your triggers and patterns. You now understand your patterns. You've identified your triggers. You know exactly which emotional states lead to your worst decisions. But knowledge alone changes nothing. Knowing you shouldn't eat junk food doesn't stop you from eating it at midnight. Knowing you shouldn't check your ex's social media doesn't stop you from doing it anyway. Information is useless without structure. Most investors fail at this point. They have insights, but they can't put them into practice. They keep a journal for a week, see some patterns, feel enlightened, and then immediately go back to making the same mistakes. Why? Because they never set up systems to turn insights into automatic behaviors. Step 4. Create your personal trading rules. This is where your daily data transforms into a protective armor. Rules based not on generic advice you read online, but on your specific psychological weaknesses. Rules designed by you, for you, to protect you from yourself. Let me illustrate how this works with real examples. Let's say your journal reveals that you engage in revenge trading after losses, and this revenge trading has a profit rate 35% lower than your normal trading. General advice would say, don't do revenge trading. Useless. Everyone knows that. Most people can't do it just with willpower. Instead, create a concrete, actionable rule that includes the consequences. When I faced this issue, my rule was, rule. After any losing trade, I must step away from my trading desk for at least 20 minutes. During this time, I will go for a walk outside without my phone. If I return and make another trade within those 20 minutes, no matter what conditions arise, I must close my trading platform for the rest of the day. Do you see the difference? This is not a vague intention. It is a concrete protocol that is automatically enforced. The rule is not based on my willpower at the moment I experience emotional turmoil. It completely removes me from the situation. Now, let's say your journal shows that you overtrade when the market is quiet. You get bored, start seeing opportunities that aren't really there, and make mediocre trades just to feel like you're doing something. Rule. On days with below average volatility, I can make a maximum of 2 trades. Before making any trade on a quiet day, I must write down my rationale and rate the setup's quality on a scale of 1 to 10. If the rating is below 7, I cannot make the trade. There are no exceptions. Here's another example. Let's say your data reveals that you make your worst trades after staring at charts for more than 3 hours straight. Your ability to focus deteriorates, your patience wears thin, and your decision-making ability suffers. Rule. After 3 hours of screen time, you must take a mandatory 45-minute break away from all screens. If you skip this break and trade in the 4th hour, you must reduce your position size by 50% for the rest of the week. Pay attention to the structure of these rules. They all consist of 3 components. First, a specific trigger condition, after a losing trade, on slow days, after 3 hours of screen time. These are observable and measurable conditions that require no judgment at the time. Second, the required action. Step away from the desk for 20 minutes. Write down your reasoning and evaluate the setup. Take a 45-minute break. These are concrete behaviors, not feelings or intentions. Third, a consequence to be applied in case of violation. Close the platform that day. You cannot trade. Reduce position size by 50%. These consequences should be painful enough to matter, but not so severe that you cannot implement them. Now comes the critical part. Your rules must come from your data, not from a trading guru, not from a book, from your journal. Because a rule that addresses someone else's weakness is worthless to you. Maybe you don't have a revenge trading problem. Maybe your problem is the opposite. Maybe you hesitate on valid setups because you're afraid of losing. Your journal will reveal a pattern of disappointment after missed trades and the subsequent chase. Your rule will be entirely different. Rule. When a valid setup that meets all my criteria appears, I must enter within 30 seconds of identification. If I hesitate for more than 30 seconds, I must immediately record the reason in my journal. If I record fear or uncertainty more than 3 times in a week, I should trade only half my position until my confidence returns. This rule forces a hesitant trader to act. It is the exact opposite of rules that force an impulsive trader to be patient. Same framework, completely different application. Take time to create your rules. Make your rules specific. Write them down, print them out, and put them next to your screen. And this is the most important part. Follow the rules even when you don't want to, especially when you don't want to, because the moments when you don't want to follow the rules are the moments when you need them most. Step 5. Create your daily practice system. Rules protect you from your worst impulses, but rules alone are not enough. You need daily practices that keep you psychologically fit, maintain your self-awareness, and prevent you from falling back into unconscious patterns. Think of it like physical fitness. You may have rules about not eating junk food, but if you don't exercise regularly, sleep well, or manage stress, you'll eventually break those rules. Your willpower will run out, your discipline will falter, and you'll find yourself at the bottom of a bag of chips. Trading psychology works the same way. You need daily practices that build and maintain your psychological strength. Morning routines where you make too many decisions before trades can lead to decision fatigue. By creating routines, you can reduce the number of decisions and implement rituals tailored to your personal life that prevent mental exhaustion. Most people want to make quick gains by doing what no one else dares to do, rather than gaining small advantages every day with boring discipline, building brick by brick. That's why they turn into gamblers. Markets generally reward monotony. They reward investors who show up every day, implement their plan, and don't deviate from it. Now, here's what most people misunderstand. They think discipline is about willpower. It isn't. Discipline is about creating systems and structures that automate good decisions. You need the same routine every day. Routines aren't magical. They eliminate decision fatigue, allowing you to cut through the brain fog. Imagine your brain's focus level as a 100-unit health bar. Every decision you make, based on its importance, kicks at that decision-making bar like Chun-Li in Street Fighter. If you don't take precautions, your focus will eventually be knocked out. If you have to make 50 small decisions before doing a single thing, your mind will be exhausted before you even start. But don't try to change everything at once. You will fail if you try to make big changes. You should start with small steps. Maybe you should decide to check the same 3 things every morning before trading: market structure, key levels, and news. Do this for a week. Then maybe add a pre-trade checklist. Test it for a week. If it improves your trades, stick with it. Maybe you need a routine that checks your mood more. Find exercises that you think will do you good. Modify your routines to suit yourself. At some point, your routine should be so ingrained that you don't even have to think about it. You should feel uncomfortable when you don't follow your routine. That's when you realize your routine is working. And that's the key point. You need a routine that suits your trading style. If you trade daily, you need a morning routine that keeps you alert and focused. If you're swing trading, you need an evening routine to review your setups. There's no one-size-fits-all solution here, but everyone needs something. Second, the emotional summary. Looking at your daily entries today, what was your overall emotional state? Were you in control or reactive? Did you follow your rules or break them? Third, the lesson learned. What did you learn about yourself today? Not about the market, about yourself. Write it down in one sentence. I learned that I get impatient if I don't trade after the first hour. I learned that checking Twitter during trading hours disrupts my concentration. I learned that I trade better when I exercise in the morning. Fourth, preparation for tomorrow. Based on today, is there anything you need to do differently tomorrow? Are there any rules you need to reinforce? Are there any triggers you need to watch out for? The cumulative effect of self-awareness. Here's what happens when you stick to this system. The first week feels strange and boring. You resist. You think it's excessive. You want to skip steps. Don't skip them. In the second week, you start noticing things you never noticed before. Patterns emerge. You catch yourself in the middle of a trigger situation and pause before reacting. By the end of the first month, your trading will feel different. Not easier, but more conscious. You'll feel more in control. By the end of the third month, confronting yourself will become automatic. Keeping a journal, checking in, rituals, and reviewing your charts will become as natural as breathing, and your results will reflect this transformation. Let me clarify something. This system alone won't make you money. You still need a valid strategy. You still need proper risk management. You still need market knowledge. But without psychological mastery, all of these are like a table with a missing leg. You will sabotage yourself over and over again and not even understand why. There is one common trait among traders who stay in this game for the long haul, who are still profitable after 5, 10, 20 years. They know themselves. They have accomplished the uncomfortable task of confronting their inner demons. They have built systems that protect them from their worst impulses. You have what it takes to be one of them. 5 steps, frameworks, daily practices. The only question is whether you will actually do it. Most traders won't. Most traders will watch this, nod their heads, get motivated for a day, and then revert to their old habits. They will continue to blame the market, the algorithms, the manipulation. They will continue to search for the next strategy, the next indicator, the next magic solution. But you are different. You are still here. Remember, if you can't control your emotions, you can't control your money. Start keeping your trading journal before your next trade. Begin the process of confronting yourself. Because the hardest thing in the market is managing yourself. Prices are just a test. To control your emotions, you first need to be aware of them. That's why keeping a trading journal can be the first step in this process. Thank you for watching Mindful Wealth. We understand the challenges of mental fatigue in trading and the importance of managing your psychology. If you want to see more videos on trading psychology, you can like the video and subscribe to the channel. Wishing you always find profitable opportunities. Have a nice day.